Good day, everyone. Today I'll be covering a topic that I think is the most difficult thing to understand about the markets, and that's options trading. Now, options themselves I don't think are particularly difficult to understand. It's just the information out there is really convoluted and just really walls of text that aren't quite helpful. So I'm going to try and break it down and keep it as simple as possible so you guys can start trading options. Now, what options are is they give you the right to buy an asset or to sell an asset at a specified price. And that specified price is called the exercise price or the strike price. Now, buying one option contract gives you an exposure to 100 shares for a company, or 10 index shares, such as the ASX 200. There are two positions that you can open when you trade an option, and that is you buy to open, then sell to close, or you sell to open and buy to close. Now, we're going to focus only on buying to open because that's what 95% of us do. Selling to open is a lot more complicated and holds a lot more risk. So we'll only be covering buy to open because that's really just what we're going to be doing. Now, there are two strategy types. You've got puts, which are bearish, and calls, which are bullish. Which means if you ever buy a put, you want the stock price to drop. If you ever buy a call, you want the stock price to rise. When it comes to buying to open, it means buying an option does not mean you're obligated to convert those options into the underlying asset, which would be shares or the index. So if you buy, let's say, $1,000 worth of options, the most you can lose is that $1,000. That's called the premium. You cannot lose more than the $1,000 if you buy to open, whether you buy puts or whether you buy calls. Now, the reason options can be complicated is because of these option Greeks, the delta, gamma, theta, zeta, the vega, and rho. So I don't particularly focus too much on that. You can look at this at your own time. A couple of these are important in the long term to understand, but really do this in your own time. I don't consider it a must-know component of options trading. Because options trade just like stocks. You can buy the option and sell the option just the same way you can buy a stock and sell a stock. So here's an example of trading an option on CompSec platform. So we have here ASX XJO. So XJO is the ticker for the ASX 200 index. So what we have here is the strategy type. So you can look at puts or calls here. You got the strikes, which means you can see how many options are expiring on a particular day. You can change that from 6 to 12 to 24. And then if you got the expiry time, so you can look at options between 0 to 3 months, 6 to 9 months, or 12 months plus. You've got the expiry day. So it's important that your options are in the money at this time, or they expire and they are literally worth $0. And we'll cover that a little bit later. This is the code. So just like when you're putting in a stock code, let's say CBA for Commonwealth Bank, this is the code for the option. So XJO C19. This is the bid and ask. So you got the buy price and the selling price. Never buy at the offer price here. You want to find what's exactly in the middle and maybe add 1 cent to it, and you'll almost always get filled. Open interest, that's how many options have been traded effectively and have not been converted. Volume is how much has been traded today, in this case none, for this particular option. We have the last traded price, in this case 74 cents, and we got the exercise price that I was talking about, which is the strike price as well, and that's 5,525 for this option. Now we can see the last traded price for the ASX 200 is 5,541, which means that we are in the money. Now you can see in the money is represented by these blue lines here, and what that means is if we have this option, we are in the money. That means that the price is higher than our strike price, and that's what you want when you're buying calls. If you're buying puts, you want the stock price to be lower. Now, here's an example of how to trade an option. Let's say we want to buy 10 contracts of XJO C19. And we want to get the mid price, which is 92 cents. So we put in 10 contracts at 92 cents and we put our stock code here, or in this case, an options code. And we want to buy to open. That's important. So our premium will end up being $9,200 plus a bit of brokerage on top. Now, this is what it looks like on expiry day. Let's say the ASX closes at $5,600, which is what we want. We want the ASX 200 to close above our call price, our exercise price for our call option. Because we have an exposure, if we have a look here at the simple mathematics, so we have 10 contracts and there are 10 shares from the index. So that gives us 100 index shares. So that gives us an exposure of $552,000. Sorry, $552,500. Now, when it expires at $560,000, the difference between these two is $7,500 in profit. That's the difference. That's why we want the actual ASX price to be higher than our exercise price, because we make profit on this difference here. But don't forget that we paid $9,200 for the right to exercise these options. So that's our premium. So really, we end up with a loss of $1,700. Because even though we made $7,500 minus the premium, we end up with a loss, and that's excluding brokerage. Now let's say in a different scenario, let's say we got the exact same options, but the XJO or the ASX 200 closed at $5,800, which is 275 points above our exercise price. The difference here would now be $27,500, and that'd be our profit. But we've got to take away our $9,200 premium, which is what we paid for the option, for our premium, our right to convert. And that gives us a profit of $18,500 excluding brokerage. Now keep in mind, guys, you don't have to hold options until the expiry day. So this expires in 4 trading days from now. So you can close this off whenever you want. You can trade it like a share, and you'll probably get a very similar outcome. If you wait to expiry, the broker will convert those options to shares for you and sell them on your behalf. Now, I called CommSec to confirm that this is the case, and they told me it is. So before you do anything, please contact your broker and find out what happens if you expire in the money, because that's important. I don't believe you'll ever expire in the money and get nothing out of it. I just don't see that ever happening on any broker platform. So do double check with your broker, please. Now, this is a visual representation of buying calls. So we have our loss potential, which is $9,200, and with our strike price of $5,525. Now, when the share price goes up, we break even on the strike price plus our premium. So in this case, if you do the basic maths, it's 5,617. That's where the ASX 200 needs to be for us to break even, to earn $0. And then as the price moves up, our profit potential for calls is unlimited. Now the exact same but inverted is for puts. I really just used the same image and inverted it. But you get the idea. It's the exact same. You've got your limited loss potential, which is, let's say, $9,200 in puts. You got to calculate the strike price plus the premium, and then it's got to go below that. The ASX has to close below that price, or the stock price, whatever it is you're trading. Now, the most important thing you need to understand is the value of your option. It decays over time, and it decays rapidly. The closer you are to expiry, it can get pretty ugly. So let's say we have 6 months expiry and we've got an option for a stock. At first it's valued at $10, and in 3 months' time, if the stock price hasn't moved, it'll be devalued to $5, and then eventually as it expires, it'll be worthless. That's assuming that it's out of the money. If it was in the money, there'd obviously be some value to it. Now here's an example of decay. You can see what happens at the exact same strike price, $5,525. The only difference is this option here expires in less than a week, and this expiry here has an extra week on top. And you can see the difference in value, $1.40 to $1, right? That's a 40% decline in value. So keep that in mind. Options do expire quite rapidly, or rather they decay rapidly. Now here's an example of a trade that I've done in the past, and this was a Telstra option. It was a Telstra call. Now I bought $300 worth of premium, and with the fees on top, it got a little bit expensive. I mean, 20% of the position was basically fees. So what it was a chart set up here, and Telstra and these other blue chip stocks, they don't really move a lot in a single day. So I saw this chart set up here, and there was news going around about Huawei being banned in the US. There was talks about it, and there was talks about it here as well. So I bought this on a Friday. It was a $3.10 was my strike price for the call. So I bought in really cheap, 1.5 cents. 1.5 cents for 200 options in order to make $3.10 strike price. Now, what happened over the weekend, because this was traded on a Friday, is Huawei got banned from selling 5G in Australia. So the competition to Telstra was a lot less. And this happened on Monday. I ended up closing out my position when the price was $3.15 because I didn't know where the top was going to be. The top ended up being around $3.20. And ultimately, because of that move, I ended up selling my options like they were stocks. Instead of 1.5, I sold them at 6 cents. So I made a nice return of $1,200, excluding the fees. And it was a nice sort of about 300% profit on that if you take away the fees. So the potential on that day was to make about $3,000, but I didn't hold it long enough, and of course I didn't know where the top was. I was happy to make 300% in one day. Now, the reason that I made so much on a single options trade is because these options were going to expire in 2 or 3 trading days. So I had 2 to 3 days to hit $3.10. So that's a high risk trade. Now I was banking on this setup to break out to the upside. And the added bonus was the news from Huawei. And I also anticipated that something could happen. That was just a hopeful trade there. But of course there was a technical setup preparing it to break out as well. So I had a justified trade here. Otherwise, if the chart looked any different, then I would not have bought it because of the short time expiry and the very unlikely nature that it would hit $3.10. Let's say the stock price only was somewhere around here. There's no chart set up to break in 2 days to $3.10. So you've got to really know what you're doing with technical analysis and fundamental analysis if you want to trade options. With short expiry times, you definitely need to know what you're doing. When you start out trading options, you really want longer expiry times. You at least want 1 month at an absolute minimum. And you don't want to trade too far out of the money because the further out of the money you are, yes, the options are cheaper and you can get exponentially higher returns, but the chances of you making money from far out of the money options is just so unlikely. Now, this was very much a high-risk trade. This was out of the money and short-term expiry. So this was as high-risk as it got. I only trade maybe options 3 times a year because options give you exposure to some of the biggest stocks on the market, usually the ASX 20 or the index itself. Now, I don't want to dish out $500,000 in order to make $1,200. So instead, I bought options and I risked that $363 in order to make this trade. So guys, I hope that's cleared up and explained some things about options trading. Now it's all about looking at the market and seeing how it works for yourself.